Hello everyone and welcome back to the channel. This week is another fantastic video. We are going to be talking about stablecoins and specifically about Tether because it's really one of the main stablecoins out there. There's some really interesting properties and some really cool aspects of these coins. So I hope this kind of lays it out and you can kind of utilize this in your crypto portfolio and become a better crypto investor. So I hope you like this one. I'll see you all next week. Welcome back to another weekly video, everyone. This week we're talking about stablecoins and more specifically about Tether. A stablecoin is very much how it sounds. It's an IOU coin that can be traded for a stable amount of an asset or fiat currency, depending on what we're talking about. If it is a fiat currency, commonly one coin is worth $1. There's four main types we're going to be talking about in terms of stablecoins available in the market, the most common being Fiat-Backed stablecoins, and the four are as follows. There are Fiat-Backed, as we've talked about, crypto-backed, precious metal-backed, and algorithmic stablecoins. Now we'll start by talking about Fiat-Backed stablecoins, and they have a few pros and cons, the pros of which include the lack of volatility that other crypto has, and this is definitely a good thing, and price changes are minimal, meaning there is virtually zero exchange rate risk, and this is very appealing to investors. The cons are that this means that coins must be centralized to maintain the peg, and this is done by a corporation. These types of stablecoins commonly operate on the Ethereum network or blockchain, and offers stability of fiat currency while being easily transferred to other cryptos, and is said to be useful as a medium of exchange as well. So the next one we're going to talk about is crypto-backed stablecoins, and as it sounds, they are backed by a specific cryptocurrency which is utilized as the asset for which collateral is posted. And the most common of these is Ethereum. It's used quite often for these types of coins. So the wild fluctuations in price call for difficulties in collateralization, and these are often over-collateralized to compensate for this. So what does that mean? This means that for every $1 of stablecoin, this requires at least $2 of collateral in order to integrate large price swings, and some are even bigger than that. Crypto-backed stablecoins carry a large amount of financial risk, and this is partly because they rely on an asset in the same asset class for collateral, which reduces the diversification overall. And this is because they're in the same industry, and same industry assets always introduce this kind of financial risk. Third, we have the precious metal-backed stablecoins. These are a little bit more rare, but they are often backed by commodities such as gold or silver. They are also very good against volatility, but are centralized, unfortunately, by a company who pegs the coin, and this is fairly common for stablecoins. And the last that we're going to talk about is algorithmic stablecoins, and they're actually not backed by any kind of asset. An algorithm buys or sells, or supplies and destroys coins to bring the coin back to par if it fluctuates in value due to supply and demand changes. And this is much like the traditional central bank operates and how they create and destroy currency. There's a serious cost associated with this, unfortunately, and if it's done too often and in the long run, this can become very costly. Now let's discuss why it makes sense to own some stablecoins. So in 2010, someone bought 2 pizzas for 10,000 Bitcoin, which would today be worth over 400 million US dollars. That's insane. So to avoid this type of FOMO, as we call it, from appreciating cryptocurrencies, investing in stablecoins to utilize for transactions and everyday purchases allows one to keep holding your crypto but using the stablecoins as your medium of exchange. Now, the Bank of International Settlements, or BIS, has argued that stablecoins are also favorable in terms of their anti-money laundering, tax compliance, cybersecurity, data protection, and financial inclusion properties, and this makes them very favorable. And now we'll turn and talk about Tether a little bit. So Tether is one of the most common stablecoins currently in production. It's also referred to as USDT or USD Tether. It has a consistent one-to-one mapping with the US dollar, and therefore it's fiat-backed. The USD is then linked to cryptographic tokens called tethers. So the Bitcoin and ETH blockchains and a proof of reserve system audit and make sure that all coins are fully backed by fiat currency at all times. Due to the use of the blockchain, they can be bought, sold, exchanged, used, and spent like any other cryptocurrency, and this makes them very valuable in the crypto world. And the name comes from each coin being tethered to the US dollar and not being able to be altered. Now, interestingly, the Tether Framework consists of 3 important layers, and we'll break these down. So the first is that Bitcoin blockchain that we've talked about. So this consists of the blockchain and contains the Omni consensus system embedded in it. This is fairly complex. The blockchain ensures transparency and security of all Tether coins transacted. The second is that Omni layer. So what this layer does is it allows the creation or destruction of tethers through metadata, which is actually stored on that first layer in the blockchain. There's also security systems and a built-in wallet for users to utilize. And this layer also reports circulation of tethers throughout the system as the coins change hands, so that everything is recorded and visible for everybody. And finally, we have the Tether limited layer. This is essentially the business entity of Tether, which has the sole purpose of strictly withdrawals, deposits, and storage of fiat currency for collateral. This is essentially the big clearinghouse for the Tether network. The system's solvency relies on the exclusive right of Tether Limited to issue and destroy coins. So its goal is to issue new coins equal to fiat deposit of an investor, or 1-to-1. Users can also buy and sell from holders and exchange for other cryptocurrencies, which makes it very useful. And when traded for USD Cash, Tether Limited destroys the coins and pays out the number of coins as the number of dollars. And this is because it's that 1-to-1, so they are also responsible for this. So this monopolistic power upholds the integrity and value of each Tether coin, much like Bitcoin has. And as standard, Tether Limited holds 1 USD in its reserves for every single coin it issues. This makes it easy to verify by everybody, and this is the beauty of that blockchain system. And every transaction and reserve transaction can be viewed and verified at any time anybody pleases. So stablecoins are not yet widely accepted as a medium of exchange. So currently they serve as investment vehicles primarily to easily allow crypto holders to reduce their risk and easily get out of these holdings if they so please. There's an easy process to exchange crypto to and from Tether or other stablecoins, and again, this makes it very easy and liquid. Now, the benefit of volatility reduction will inherently decrease as crypto market caps grow, which indicates smaller price movements from buying and selling pressures. So over time, this will actually reduce the need for stablecoins in the future, unless they become very useful as a medium of exchange, which is the hope. Another tricky aspect is the peg itself. History has shown us time and again that fixing or pegging exchange rate is doomed to fail. So we can look at some examples here. The peg of the US dollar to gold and the Bretton Woods system of fixed exchange rates are great examples of these regimes that failed. Mainly, this was due to the cost of maintaining that peg and the difficulty. And just for these reasons, the usage of stablecoins in a long-term portfolio is questionable based on the current state of the world. It does solve short-term volatility, but longer-term holdings may not need this protection. And a medium of exchange may become useful if it is adopted by many hands. Now, fortunately, migration to other cryptocurrencies, as we've mentioned, is very easy and painless if any aspect of these coins changes. And again, it is backed by the corporation, so it's easy to get your money back. The centralized nature of stablecoins may be unfavorable to some investors, however. This kind of defeats the purpose of crypto having to be linked to an entity and not being fully owned by the people. And bankruptcy also possibly becomes an issue, although the collateral does help the situation and will easily be able to withdraw holdings due to the holding of the exact reserves of Tether. I'll see you all next week.